looking for leading indicators. Man, I don't know why, but I'm back into the divergent mode. Bearish divergence, bullish divergence. And right now, since we're at the end of the economic cycle, I'm looking for bearish divergence to really confirm what's happening. And if I find something else, well, I'll add that to the weight of evidence. But you find a new tool or a new angle to look at things, and then you just pick out of your toolbox previous proxies you used to use because, yeah, true. I used to use GM to know how the health of the overall market. If GM can make new highs within 3 months, then the market would eventually roll over. That's stuff Stan Weinstein used to do. And then HYG guy, high yield corporate bonds. And this little guy, we knew that when this thing broke down, really broke down hard during the 2008 crisis, when it broke down in 2015, broke down hard and only really recuperated once you got out. Remember, the stock market did like a double bottom, and then after that went back out. So this guy, I don't quite sure. Corporate debt, corporates issuing debt to be able to raise funds to do share buybacks or expand their enterprise, whatever it is. So if they can't pay the interest, it's not like the government, right? The government could print more money. They still have to pay interest, but they could print money to pay the interest. But a company, if the interest rates starts going up and they get a squeeze on that liquidity and have difficulty paying their interest rates on those loans, on those bonds, the money that they owe, the people that lent them the money, then it's just kaboom, right? It's like a slowdown. It freezes everything. They have no more money to do share backs, buybacks, or whatever they were using that money for growth, to increase their price stock. I don't know, whatever. They can't do it anymore. And this is what you see here, these big drops when it has difficulty. All right, what am I rambling on about, guys? So let's look at, magic, SPX. Let's compare it to the SPX. So we're going to look for divergence. Let's go back to 2008. Squeeze that. I don't know why I don't have more data than that. Did these exist? Is it just my feed from Oanda, from TradingView? But I still got this. So this is the monthly candle chart. 2007, May, SPX did a high, October 2007. So what happened here? Oh, Patrick. I want that one, do a line. Oh, sorry guys. So lower highs on the high yield corporate bond, higher highs on the SPX. So already the bonds are, I can't go any higher while the SPX was keeping going higher. That's a bearish divergence. That's going to put pressure on the SPX saying, look, I'm going to push you down. And after that, what happened? They dropped they dropped together, and that brought you down to a monthly defined breakdown line right here. When was that? June of 2008. So it actually broke down. There's a big warning sign a few months before the actual full meltdown that we had in September. Broke down here. So here could have been a big warning sign. And what's happening here is sideways move. So it broke down in June. That could have been your say, hey, I'm out of here. July, sideways move, getting close to the 12-month moving average. So right here were more opportunities to hop on board to short this. And this could have given you a big clue that a big drop was coming down. If this couldn't recuperate, go back up, something had to give, and it did give right here in September. It just totally failed. And after that, eventually this thing picked back up. Right here. Do we have even now? We have bullish divergence, higher highs, higher lows. Sorry guys, sometimes I don't even realize I'm doing it. I don't correct myself. So on the SPX, lower highs, lower lows. On the high yield bonds, higher lows, bullish divergence, hidden bullish divergence. And that's telling you the SPX, okay, you're going to get pulled back up. The bonds are ready to go back up. Still not out of the woods yet, but going to give another go. Some energy built up until after that it broke out above 12-month moving average and off it went. But never went back to previous highs. It's very fragile. 2015, let's look at that. 2015, and you had lots of warning signs. Hogging lower highs on the bonds, higher highs on the SPX. So that's telling you, look, SPX, you're going up high, but the market's telling me that these bonds aren't worth that much. They're getting riskier territory. And after that, what you do, weight of evidence, you add your horizontal breakdown line on the monthly chart. That you gotta respect that, super powerful. And when you had that monthly candle close, so in June of 2015, before the SPX started breaking down, you could have said, big warning sign. Same thing as in 2007. You had a few months leeway. Right here, you had your signal to say, okay, I'm out. Never really pulled back to the 12-month moving average. Kept going down, down, down. And even when the SPX pulled back up, these bonds, they're like the worst of the worst. These bonds, they still didn't recuperate. Double dip. So that could even been a sign that we were going to double dip again because it didn't go back up. And then it went down. Then you got those tweezer bottoms. And then, okay, the buyers came in. They said, okay, we're not going any lower than that. And that's your bottom, your tweezer bottoms. And after that, off you go. So it's really a leading indicator, the risk sentiment. Not a lot of people are looking at corporate bonds. But if the companies, they can't pay the interest on them, they're going to go down. And companies, after that, their value is going to go down. Their growth is going to go down, or whatever metric people look at to justify buying or selling stock. So if this cracks, this is the first crack you got to look at. So right here, you got it. You got a few months leeway. Here you had it. You had a few months leeway. And you even had those bottom indicators. So if you have a bottom pattern on the corporate bonds, then you might be bottoming on the stock right after. And here we are today, guys. So this is the curiosity of today's chart. Let me bring that up. All right, so look at that, man. Wow, this has been weak for a while. Lower highs, lower highs. While this has been doing, okay, I'm going to do it from here. Higher highs on the SPX, lower highs in between these 2 points on the corporate bonds. So already we're back into 2015 mode. We're back in 2007 mode, the 2008 mode. And then we're consuming that. Oh, broke down. And that's why here I'm not quite sure. There's the gap down. Okay, I believe in October this actually broke down. I think this is the equivalent of where we are here and where we were in back here, right here in 2008 June. So June, we had 1, 2, 3 months leeway. In 2015 June, we had 1 month, 2 months leeway before that first dip. And after that we had that dip, that close. And October, November, December, we did break down. We did have that dip. And now strong pullback. That famous V-shaped pullback we're getting. Here is where we are now. So I believe that we're still in that downtrend. This is a pullback to the 12-month moving average, to that horizontal break down line, now turn resistance. We went above, But I believe that's going to be noise, that the 12-month moving average is going to save this. And then we're going to keep going down. And if the corporate bonds go down, the SPX is going to follow suit. So until I see the corporate bonds doing a bottom pattern, either can't do lower lows, it's going to do higher lows, until it does a tweezer bottoms. For me, that's going to be my leading indicator amongst my whole toolbox of word of evidence, that the bottom, the real bottom, is not set in yet for the SPX. You could add unemployment rate until, for me, it goes really back up to 8, 9, 10, 10%, until the interest rates go back down to zero, until all these other economic datas that I've been monitoring, until they go in extreme territories. For me, that's my leading indicator right here. So I'm expecting this to pull back down. And if we get a break again, if we go and we close below, I think we're even going to have a bigger pattern here. If we don't flash flood like we did in 2008, we might have even a bigger pattern here, going to retest these 2015, 2016 closes support. And then we're going to get narrow. But again, I'm not looking too much at the price for swing rules. Unless you want to play it, you could do that. I'm using it as an indicator and after that, as an indicator for my TSX, for my SPX, if it's going to crash, if it's going to pull back up infinity and beyond. And you see another one, weight of evidence. So this is going to bring me back to 2009 lows, guys, the bottom, this range right here. Weight of evidence. I'm scratching my head. I'm trying to find bullish stuff other than just the Fed printing money. Everything seems to be pointing the market. I don't think you could cheat the market. So I love talking about rates and all that stuff and manipulation. It's great stuff. But at the end of the day, I really think the market's going to figure things out. And just like happened in Japan, even if they kept printing money, they had an asset bubble. Their index, even if they kept printing money every time they lowered rates, bounce back up, print more money. But for 30 years, they weren't able to go back to even halfway up their big mountain. So it's going to be a question of doing lower lows, lower highs, lower highs, lower highs, until everybody falls asleep and just forgets everything, guys. And then you restart a new cycle. All right. Okay, guys. Thanks for watching. Don't forget to subscribe if you like this, guys. I appreciate it.